Stocks start strong out of the gate but stumble at the finish line. After spending most of the day in positive territory, the Dow closes off 3 points. The world's central banks help keep things on track by once again pumping billions of dollars into their system.
According to the Federal Reserve, banks are cracking down on lending standards on subprime mortgages. We'll have the results of the Fed's new survey and what it could mean for a possible rate cut.
Sales are down at Sears, but shares of the company are up after a major stock buyback is announced.
And fewer Americans are giving it the old college try. We'll examine one reason why education may be the best investment America can make.
I'm Paul Kangas.
And I'm Susie Garoff. This is Nightly Business Report for Monday, August 13th.
Nightly Business Report is made possible by
A.G. Edwards. Objective financial advice can help make sure your nest egg is ready when retirement arrives. A.G. Edwards, fully invested in our clients.
Franklin Templeton Investments, providing a unique perspective through the specialized investment expertise of Franklin Templeton Mutual Series and Fiduciary Trust. Franklin Templeton Investments, gain from our perspective.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.
Good evening, everyone. Stocks on Wall Street stabilized today following last week's extreme volatility. The major indices ended little changed as a late-day sell-off wiped out earlier gains. Still, subprime concerns continue to hang over the market. Goldman Sachs injected billions of dollars into one of its troubled hedge funds, and the Federal Reserve continued to pump billions into the banking system. Erica Miller reports.
The news in the credit markets was positive for a change, bringing calm back to Wall Street. Investors were pleased the Federal Reserve and other central banks again injected money into financial markets. David Katz, Chief Investment Officer of Matrix Asset Advisors, says the strategy is a wise one for the Fed.
They made it clear that they're going to support the markets financially, provide great liquidity to the system, and it's much cheaper for the Fed to do this now than to have to lower rates a month or two out.
At the market open, the Fed added $2 billion in reserves to the U.S. banking system. The European Central Bank pumped in about $65 billion into its monetary system and noted that credit markets are returning to normal. The Bank of Japan added $5 billion. According to research firm Decision Economics, the global cumulative injection total of the past 3 sessions now stands at over $389 billion. Investors were further reassured by news from Goldman Sachs that it would shore up one of its troubled hedge funds with $3 billion in new cash from a team of investors.
They identified this as being one of the better opportunities in the market. So basically what they're saying is the market sell-off has been overdone, especially in certain quant models.
To a lesser degree, an upbeat retail sales report also helped soothe investor nerves. Sales rose a modest 0.3% after a 0.7% drop in June. Portfolio strategist Stephen Wood says that alleviates worries that consumers are cutting spending because of concerns about the economy and stock market.
I think that's part of the forgotten news of the last couple of weeks is that the economic fundamentals are healthy. The consumer is doing okay, the U.S. economy is doing okay, jobs are plentiful, and wages, if anything, are a little bit too high for the Fed's liking. So I think right now the global economy story is still intact.
Most experts predict extreme volatility will continue in the markets. Although there's inflation and other data out this week, the bigger focus is on the extent of troubles in the credit markets. Erica Miller, Nightly Business Report, New York.
Wall Street began the week with a solid upturn as investors gained confidence after the Fed and other central banks injected more money into their banking systems. Just an hour into trading, the Dow was up 82 points and the Nasdaq rose 22. The rally lost some of the steam during mid-session amid lingering doubts that the worst of the subprime mortgaging crisis was over. The Dow was still up at 50 points at 3 p.m., but the gains vanished in the final hour as nervous traders cut positions they didn't want to hold overnight. The Dow Industrial Average closed off 3.01 at 13,236.53. The Nasdaq Composite fell 2.65, ending at 2542.24. Standard & Poor's 500 off 0.72 at 1452.92. The bond market, 10-year note gained 12/32 to 99 and 28/32, putting the yield down to 4.77%.
It looks like the nation's banks are clamping down on how they make mortgage loans. A new Federal Reserve survey shows a growing number of banks are tightening lending standards on subprime mortgages and even on prime mortgages. It looks like things are getting tougher. In its latest quarterly survey of bank loan officers, the Fed found 56.3% of banks responding said they had tightened their loan parameters for borrowers with weak credit histories. Just over 40% of banks responding had ramped up standards for non-traditional mortgages like the so-called Alt-A loans. And about 14% of banks said that even for borrowers with good credit records, mortgage standards were getting more restrictive. Joining us now with more analysis of that Fed survey, Alice Rivlin, Senior Fellow at the Brookings Institution and former Vice Chair of the Federal Reserve. Hi, Alice. Nice to have you on the program.
Hi, Susie.
Well, let me begin by asking you, how do you think the Federal Reserve is going to factor in this information of the survey, along with all the other parameters that it looks at when it's assessing the economy? How important is this survey?
Well, the Fed gets an awful lot of information, and the banking survey is one of the things they do that tells them something about what banks are doing. This survey seemed to me to have no surprises. If you were a bank, wouldn't you be tightening up on subprime loans at the moment? And to find that banks are actually doing that is not a surprise to me and probably not to anybody else.
Do you think that the Federal Reserve policymakers are pleased that banks are tightening up on, on giving out loans, considering that they had been somewhat critical of banks that had been too loose when it came to lending?
Well, maybe, but it's a balancing act. Subprime lending has increased over the last few years enormously. It has helped a lot of people buy houses who wouldn't have been able to otherwise, a lot of them lower income and minorities. So there's a lot of plus there. It just got a little out of control. So I suspect the Fed is thinking, well, maybe this is a little bit more neutral.
As you know, we've all been hearing people from Wall Street and from the business world saying the Federal Reserve needs to cut interest rates now, given the subprime mortgage mess, given the market sell-off, and also this credit crunch. Do you think the Fed should cut interest rates now?
No, I don't. I think they did exactly the right thing when they held on to their Fed funds rate last week. They have put a lot of liquidity into the market, and that's good, and their central banks around the world are all doing the same thing. It looks today anyway as though it were working, as though the markets were stabilizing, and that's good. And I don't think they're going to have to cut interest rates. If they don't have to, that I think is all to the good.
But what don't you see that's going on in the marketplace that would force the Fed to cut interest rates? Why inject liquidity into the system rather than cutting interest rates?
Well, they're injecting liquidity into the system by defending the interest rate they've already got, which seemed to me about appropriate. The case for lowering interest rates would be if they saw the real economy slumping and jobs falling off, unemployment going up, or something like that. We haven't seen any of that. The economy seems to be in reasonably good shape. If they can stabilize the credit markets with this liquidity move, then an inappropriate cut in interest rates can be avoided.
As a former Fed governor, you've sat through many crises before. What else should the Fed be doing?
I think they're doing what they can do. And they may have in mind what happened in the fall of '98, when in a somewhat similar but rather different situation, we did cut interest rates. And afterward took quite a lot of criticism for fueling the stock market boom and the dot-com craze. I think that may be what they're trying to avoid. If they could stabilize without cutting the rates at this moment, they won't.
A lot of people say that the situation that's developing now could be a repeat of the financial crisis of 1998. Do you see it going down that pathway?
Well, what I see is recovery. So far, so good. We don't know how long it will last. And remember that the crisis in '98, the Fed did work through it. It did not become a general rout in the markets. What we were afraid of at the time was that the international crisis would ricochet around the world again and countries like Brazil would be in trouble. But that didn't happen.
So what do you think of the way that Fed Chairman Ben Bernanke is handling the situation so far?
I think he's doing great. He's doing what a central bank ought to do, and he's doing it methodically, and he's explaining what he's doing, and so far it seems to be working. Now, that doesn't mean that that they won't have to do more. They may.
All right, we'll leave it there. Thank you so much, Alice, for coming on the program.
Thank you, Susie.
My guest tonight, Alice Rivlin, Senior Fellow at the Brookings Institution and former Vice Chair of the Federal Reserve.
Troubled mortgage firm Accredited Home Lenders is going to court to force a private equity firm to go through with plans to take over the subprime lender. Accredited today sued Lone Star Funds after Lone Star said on Friday it would not go through with the $400 million deal. Lone Star says it's pulling out because Accredited's financial conditions have deteriorated drastically. But Accredited said backing out for that specific reason breaches the terms of the merger agreement, and it wants Lone Star to close the deal or pay monetary damages. By its own admission, Accredited is on shaky financial ground. It is projecting a loss of up to $60 million in the second quarter, with its mortgage loans down by almost 60%.
Meanwhile, there's word late today that another mortgage company has filed for Chapter 11. Aegis Mortgage Corporation is controlled by the private equity firm Cerberus Capital Management. Today, Aegis filed for bankruptcy protection in federal court in Delaware, citing more than $100 million each in liabilities and assets. So what happens to your mortgage if your lender gets into financial trouble or goes bankrupt? That's just what many homeowners are asking these days. As Stephanie Du reports, there's an easy answer, but homeowners may still be in for a hard time if their lender goes bust.
For most homeowners, there's no reason to panic if their lender goes belly up. Most loans will be sold to another lender. But Inside Mortgage Finance President Guy Cicala says sometimes loan transfers do not go smoothly.
There's a lot of potential for problems. And, worst case is someone ends up not paying your taxes, your hazard insurance, or something else, and you get hit with a delinquent bill or something else that you've got to spend time to resolve.
Cicala says borrowers have to track down where their new payments should be sent and make sure those payments get there on time.
They can't just blindly send in a mortgage payment to a lender that they know is out of business. They probably have to be proactive and contact that servicer or somebody else and say, where do I send my next payment? Because that's normally where the problem begins.
But for borrowers with financial troubles of their own, a lender bankruptcy can be bad news. Consumer law attorney Ira Reingold says loans that have been sold can be a challenge to modify.
Now your loan is not owned by one person. It's owned by thousands of people, and it's sliced up into so many pieces that any change to your loan terms affects so many different people that it becomes very complicated to even just change the terms of your loan.
A lender bankruptcy presents the biggest hurdle for people who have a legal complaint against the mortgage company.
Now, if in fact you wanted to take an action like that against your mortgage company for giving you a bad loan, it becomes much more complicated because they're in bankruptcy court. Depending on the situation, you actually may need to go into the bankruptcy court and ask for permission to raise that claim against your mortgage company.
Homebuyers may also get caught without a loan on closing day if a lender folds. Observers say some borrowers now are lining up two loans just to be safe. Stephanie Du, Nightly Business Report, Washington.
The nation's largest tax preparer rewrote the rules today on how it chooses its board of directors. H&R Block says if shareholders approve, it'll require all directors to stand for election every year rather than every 3 years. Block says it'll make the change at its 2008 annual meeting, and directors whose current terms expire after that will be required to quit. The tax prep firm has been under pressure to overhaul its board by activist investor Richard Breeden, who wants to put himself and two associates on Block's board. Breeden wants Block to focus on taxes, Paul, and get out of underperforming businesses like subprime mortgage lending.
Well, Block is already taking steps toward that, Susie, by selling off its Option 1 mortgage subprime unit to Cerberus Capital Management. Now let's look at our other companies in the news tonight. Big board volume leader on 19.8 million shares. EMC moving up nicely, a $1.33 gain. That's 7.5%. There seems to be some excitement over an initial public offering of VM Software. That's the company's software unit, and it's due out perhaps as early as tomorrow and expected to be one of this year's strongest and hottest IPOs. Meanwhile, Standard & Poor's ranked EMC as its focus stock of the weekend, repeated a strong buy. General Electric was a 6-cent loser, and then that was followed by Pfizer, which dropped a dime. Shearing Plow moved up nearly $1. UBS Financial upgraded it from neutral to buy on a valuation basis. Time Warner was up 18 cents, even though the Sanford Bernstein brokerage cut its price target from 26 down to 21.50. Ford Motor, 14-cent gain there. Citigroup was down 46 cents. ExxonMobil fell $1.59. Bank of America edging 9 cents lower, and then Sprint Nextel, 64-cent gain. Hewlett-Packard moved up $1.22, helping the Dow, and also it led the whole tech group a bit higher today, and Hewlett's earnings are due out this Thursday after the market closes, as you see. Lockheed Martin did well, up $3.69. Bank of America upgraded it from neutral to buy. Alliant Tech Systems up $2.49. NASA has awarded the company a $1.8 billion contract to help develop NASA's next-generation flight vehicle, which is called Ares No. 1. Electronic Data Systems up only 38 cents, although UBS Financial upgraded it from neutral to buy after the stock recently dropped 20%. UBS said that limits the downside risk. Blackstone Group, and you can see by the chart, it just went public in late June at 31, incidentally. And today it had a nice move, well, edged up 43 cents, but it traded as high as $27.25. Second quarter earnings out, excluding items, 46 cents up from 11 last year, 6 cents above the street estimate. And of course, this is the first earnings report as a public company. Beazer Homes USA down $2.85. The company has delayed filing its latest quarterly report due to questions about its accounting practices and methods. Prepaid Legal Services, a good day, up nearly $7 a share on news the company is preparing to launch a national media sales campaign. And Avnet up $2.66. Citigroup upgraded it from hold to buy, did the same for Arrow Electronics, whose stock moved up $3.44. Then Polo Ralph Lauren up $4.31. The company plans to buy back up to $250 million of its own stock. Energizer Holdings up $10.28. The S.T. Robinson Humphrey brokerage upgraded it from neutral to buy and has a $125 a share target. Apple topped NASDAQ's most active list with a gain of $2.79, followed by Cisco, down 56 cents, then Google, a 25-cent loss. Research in Motion moved up $4.81. Microsoft, an 8-cent drop. Intel, 4-cent gain there. Qualcomm was up $1.03. Amgen rising $1.18. Yahoo, 63-cent advance, and NVIDIA was down 48 cents. There you see accredited home lenders plunging $3.09, huge percentage drop, almost 35%, suing Lone Star funds for backing out of their merger. And then Top Tankers is expanding. It's buying 3 new ships. Meanwhile, the Cantor Fitzgerald brokerage upgraded it from hold to buy. J.P. Morgan upgraded it from underweight to neutral. And then Sears Holdings up $7.45. The company narrowed its second quarter earnings outlook because of lower sales, but it plans to buy back up to $1.5 billion of its own stock. Those are the stocks in the news tonight. Susie?
Paul, former Adelphia Communications executives John and Timothy Regas reported to federal prison today. They'll serve time for their part in one of the nation's largest corporate fraud cases. They're behind bars at the Butner Federal Corrections Complex near Raleigh, North Carolina. Timothy Regas was convicted in 2004 and is slated to serve a 20-year term. His father, John, was sentenced to 15 years. Prosecutors say the Regases used Adelphia funds to finance a lavish personal lifestyle, then told investors the company was solvent when it was dangerously overextended.
In tomorrow's Of Mutual Interest segment, Your Money and Your Brain, we look at how biology drives investment decisions.
Mattel's toy recall is moving from store shelves to the courtroom. A Florida woman who purchased one of the recalled toys is suing Mattel and its Fisher-Price unit. She wants a refund and the money spent on tests for lead poisoning. She's also seeking class action status. 1.5 million toys made in China were recalled earlier this month over concerns about their lead paint content.
Goldman Sachs and Morgan Stanley are among 6 companies in the running to advise one of Vietnam's mobile phone companies in a bid to go public. Mobiphone is currently a state-run firm, but it could float an initial public offering as early as next year, with 2/3 of the company sold to outsiders. Mobiphone currently has a 35% share of Vietnam's domestic cellular market.
Here's a look at what's happening tomorrow. July producer prices and the June trade deficit are released. Also tomorrow, earnings from Applied Materials, Home Depot, TJX Companies, and Walmart. Tonight's commentator believes it's time for Americans to make higher education a bigger priority. Here's Michael Mandel, chief economist at Business Week.
I've been thinking a lot about college recently. Partly that's because my son is a high school senior, so of course it's on my mind. But I've also been wondering whether we are devoting enough resources to college education. Not me, not you, but us as a society. The future of work requires Americans who can do increasingly complex and creative jobs. These are the jobs that won't get outsourced. But here are some trends that worry me. The percentage of 25 to 29-year-olds with a college degree is lower now than it was in 2000. And the percentage of high school graduates going to 4-year colleges is lower as well. This education shortfall is not good. Our competitiveness and future productivity depends on having a well-educated workforce, and it's just not happening. The declining appeal of college is rational in one sense. Since 2000, real earnings for college-educated workers have been stagnant, perhaps because of competition from overseas. Meanwhile, tuition has been going up and up and up, almost 3 times as fast as the overall rate of inflation. That makes it a lot harder for low-income students to stay in school. To top it off, the student loan industry, which was supposed to fill in the financing gap, has been hit by multiple scandals. It's really time for the U.S. to take higher education more seriously. As Congress tries to clean up the student loan mess, it needs to pump money, a lot more money, into grants for talented low-income students. That's essential to ensure that we have the workforce we need for the future. I'm Mike Mandel.
Recapping today's market action, another volatile day on Wall Street. The Dow closed off 3 points after being up more than 120, and the Nasdaq Composite lost 2 points. To learn more about the stories in tonight's broadcast, to watch our streaming video, and to take part in our daily blog, go to Nightly Business Report on pbs.org. You can also email us at nbr@pbs.org.
And finally tonight, there could be some unexpected fallout on Wall Street from the recent turmoil in the credit and financial markets. Analysts say the traditional year-end bonus could take a hit. Financial losses from loan-related fees and write-offs are expected to eat into the pool of cash that's used for the checks doled out at the end of the year. One observer used the word meaningful to describe the possible reduction in bonuses. Wall Street bonus money is a key driver of New York City's economy, so Paul, it may not be a very Merry Christmas for Ferrari and Porsche dealers here in the Big Apple.
Yeah, but those bicycle dealers will do well.
That's Nightly Business Report for Monday, August 13th. I'm Susie Garrett. Good night, everyone, and good night to you, Paul.
Good night, Susie. I'm Paul Kangas, wishing all of you the best of goodbyes.
Nightly Business Report is made possible by
Franklin Templeton Investments. Our unique perspective helps us see domestic and international markets in a different light. Franklin Templeton Investments. Gain from our perspective.
A.G. Edwards. Objective financial advice can help you build a better nest egg. A.G. Edwards, fully invested in our clients.
This program was made possible by contributions to your PBS station from viewers like you. Thank you. For more information about investing, you may order Nightly Business Report's home video, How Wall Street Works, by calling 1-800-535-5864. This program is available in either the VHS or DVD formats.
We are PBS.